All right, ladies and gentlemen of the great XM world, and all of those lovely people out there who have decided to join us via the social media channels worldwide. First, let me say welcome. We're glad that you are here. Second, it's going to be a good day for you because we all know that once a week, Gil and I, my host, my guest today, we convene on what's known as Winners Wednesday. So we only have one simple rule here at XM on Winners Wednesday. You come here to win. I mean, that's the reason that we're doing this in the first place. Wednesday doesn't exist only for the sole purpose of winning. And we're going to try to do that. And we're going to do it step by step. So I'll tell you what, the chat floor is open. Anything that's on your guys' mind, questions about trading, chart patterns, setups, candlesticks, anything that's just sitting up there that you can't make sense of. We're going to try to do our very best to take a grope in the murkiness, so to speak, and make some sense out of the market for you. And let me just say a big hello and an official welcome to the COT wizard himself. Is that right? COT wizard, or did I forget it?
It is,
Okay,
yes.
COT wizard, Mr. Kill Pause, the man of the hour. I'm just here along for the ride. How is it? How is your trading going? You guys can't see it, but I'm looking at his screen. I see just an onslaught of winning trades. So your winners Wednesday is big. You look like you got some wins.
Oh,
So
yes.
what
It's
do you
not,
got going?
I say that before to you, it's not every time a year that I'm winning, but at the moment things are going very well.
Very good.
And again, I am honored to be with Mr. Contrarian.
That's right.
And for the viewers that are here the first time, you should know you have a lot of trading years experience here in the room at the moment. I think Doug is the most experienced expert here at XM Live with really more than 2 decades of trading, practical trading experience. And again, we are profiting from this trading experience, hopefully making money like we try to do every Wednesday. And
That's right.
yeah, look, for me as a swing trader, I was waiting for the market to correct, and it started to correct, and it continues to correct. And I believe it will continue to correct also. And therefore, yes, it's going very well. I am short in S&P 500. I have 2 short trades here already in. I am short in the German DAX, and the German DAX I succeeded to take from the very, very top here. And then I added to the position. And yeah, it looks not bad at the moment. And a little bit more, I wish a little bit more, and that would probably give me like the profit I was really waiting for. Like I had a drawdown series before, but now it seems that I'm end of the drawdown series and things looking good.
Yeah. Yeah, it looks good. I agree. I do think we are in bearish territory. When you said 2 decades sounds like a long time. But speaking, I got something. When somebody asked me the other day, it was like 2 weeks ago. They said, "How long have you been doing this?" I said, 25 years. And they said a quarter of a century. I didn't really think of the word quarter of a century. I was like, geez, that sounds historical, but biblical, like quarter of a century.
Almost biblical,
Wow,
yes.
that's a long time. Anyway, so markets, I agree with that. I've been saying I'm not a big fan of indicators at all. Occasionally, I'll snoop around them, and one thing I've been highlighting is the 50 moving average. I never use it as a gauge to physically make a trade. Just as a benchmark of thinking, what side should you normally position yourself on? And where I'm going with this is the markets are now all under their 50-day moving average. We haven't seen that since last December. So all year, the markets have pretty much stayed above the 50. So what does this mean to everybody? Don't confuse yourself, because I hate indicators more than anyone. It's simple. If you're above the 50-day moving average, you're usually in a bull presence, for the lack of a better word. That's another topic altogether. Bullish, bearish, kind of irrelevant. But it means that most of your trades should be long focused. You should be opening up buy orders. You should be looking to buy dips, and you should hold a little bit longer because rallies should be sustainable. When you get underneath of that, it just means now the thinking changes, like, okay, you should be careful about buying those dips. you should sell into strength rather than hold into strength or add into strength. You should probably sell rips instead of buy dips. It's just like consider it like a thinking gauge. Like I want to be positioned mostly with long trades, then positioned mostly with short trades. So kind of an advanced discussion real quickly. Why does all of this matter? Because what's the most important thing for a trader, in my opinion, is blending into the market that you're given. One of the biggest mistakes that I certainly made through my career, because I know there's a lot of new people watching this via the social media, you learn this pattern. Someone out there is going to sell you a pattern. They're going to say, my strategy works in every market. I know you heard that. This works. It does not. It doesn't work the same in every market. Like if you're a dip buyer, you were just living the life for the last 6-7 months. Try that now and see what happens. Now, that doesn't mean that strategy won't work in the market, but it's going to be incredibly different. And also, we don't have probably the time for the discussion. I'm taking up too much time as it is now. It's also a gauge of risk. If you want to be very aggressively long, fully leveraged, then you want to do that when stocks are typically above 50-day moving averages. When you get underneath of that, you want to pull back your risk as well. Or if you're a short seller, that's kind of when you want to, like now, you want to amp that up a little bit. So I do think we do go lower, but as traditionally with markets, it's just not going to be like you wake up and you go lower. We were talking about that with Giancarlo. Like you got this fading market that's constantly selling, and it's like, oh, you're still fighting. They're still fighting the dip here. Look at this. 4 times. It's like, hey, still fighting that dip. They're still there. So
it's really difficult. Every time it makes a new low, it's coming back up. I mean, again, I'm here in quite some time. I made my first short here at the top, another here. But look how many times, like all the profits gone away. So let's say I entered here, let's say, I'm in red, green, red, green, red. It's like fighting back and back. The direction is right. I am short, but it's really hard to hold to this because it's really not going smooth down. And when we look at gold, Gold is fighting around this 1900. It's crazy.
it is.
Gold
Yes,
normally is look at the volatility is out of the market. It's just fighting around this 1900. We have even a wedge here, which is indicating that maybe we will see a spike up before it goes down. It's difficult to. Normally, day traders like to be short, and the reason is fear is a stronger feeling than greed normally. So it comes very fast down and it goes very slowly up. That's what you say also. How do you have a nice saying about this? Like you go up down with the elevator and up by the stairs or something like that.
Yes,
no?
Staircase up, elevator down.
Yeah. So
sometimes it's the other way around, but yes, that's the
yes, it's
theory.
terrible. It's terrible.
You know, because usually your sell-offs are very limited but very aggressive, and that's why people like to short sell stocks and other assets, because the payoff is big and fast, and that's there's some excitement involved in that. Like here is a very good example. What you see, these multitude of green bars followed by a very big move, but it gets all taken out in 2 bars, right? Just two. This is an hour chart, so you go up practically 10 hours straight, and you lose it all in an hour and a half. That's kind of how it works. But understanding these levels are always important. When you mentioned that, you can see that there's still, like, one of the big misconceptions from a lot of traders as well is that markets go up and up or down, but it's up and it's down. There's always a move followed by another move followed by another move. So what you're seeing here in gold is all of these rallies are what we call lower highs. Each one of these high peaks are lower than the previous rally before it. I use the word stair stepping, like you're going down the stairs, right? Walking like you have those toys, the slinky. You know what I'm talking about? The little slinky. It's like the slinky down the hill, like And that's very, very, let's say, bearish tone. When it's flipped the other way, that's very bullish tone. So
Mm-hmm.
that's kind of like your short-term trend. You want to follow that. So if you do the contrarian trading, you want to be getting short on those rips and maybe even buying the dips. But this is this pretty aggressive downtrend, but they're just still going to fight it. So rule number one is positioning. You don't want to initiate that sell order right there. Like that's going to be a bad place to do it. Because like I always talk here for all the new people, idea execution management. It's the theory behind everything when it comes to trading. An idea is just one piece. It's just exactly what it is. It's just an idea. It's a way of thinking. But markets, they run on execution. Where do you decide to execute that idea? So for example, if you are selling here, you ultimately were correct on the thinking. Like, yes, it was bearish. Yes, it was going lower, but you got burned on this spike, right? And you
Yeah.
probably don't have the account size or the risk management to handle a spike of that magnitude. That's too much risk to take on a single trade for a newer account. So you don't want to get stuck in that. Like here, if you would have walked into that, you're upside down right now on a bearish chart. So hello there,
It,
Siseko. Am I saying that right?
yes. So Siteko is asking, what are the chances of Bitcoin spiking up before it dips to 25,000 mark? So Siko, the first question is here, why do you assume that it goes down eventually to 25,000? Here we are having Bitcoin. My take here is the interesting thing. Bitcoin in the past was quite strongly correlated with S&P 500. Like if there is liquidity and people made money in the S&P 500 in the stock market, they took a little bit out and they invested a little bit in Bitcoin, and then Bitcoin went up as well. Now it changed a little bit. Like, so here we have the weekly chart. Let's look maybe this at the daily chart. From the beginning of the year, which is this line here, we have a very bullish momentum. We have very bullish market from the beginning of the year. It's going up, correcting, impulse, correct, impulse. It looks very corrective in my opinion, what we are seeing here. I expect this going up further. Now, you are asking, do you think it goes up before it goes to 25? So I'm assuming that you believe it goes to 25. And again, my question is, why do you believe it goes to 25? I must say, for me, this chart looks very bullish. Now, again, this is a little bit strange because really the stock market is going down, and that would suggest also Bitcoin down. But also in the COT report, I will show you, it looks very, very bullish at the moment. So let me see if I have the COT report here. I have it. Let's go to Bitcoin, and you will see something quite interesting. Look at this. Open interest. Open interest is kind like of the volume, increased in the previous week by 12.6%. It's a huge increase week over week. 12% more market participants. You can see it here. So where are they 12%? What do they do? And everybody's buying. You see asset managers are buying, hedge funds are buying, everybody's buying. And by the way, if the dealers are selling, that means that there is a high demand for Bitcoin. Like if the dealers is selling, then everybody else is buying, right? So in my opinion, this looks very bullish. And I think we are just short before an outbreak to the top again.
I tend to agree with that there, Siseko, but again, maybe a quarter of a century worth of advice. Try not to overthink anything. Try not to do that. Like one of the reasons for anyone listening, the reason why we depend so much on charts is they serve a purpose of us figuring out price action. But to me, one of the things that a lot of people don't mention is it's a way to save you from yourself, because you're going to have this idea you're going to be so fixated on. It's going to be this. It's going to be this. But the chart is totally going to tell you No, it's not. You're wrong. And you're going to have to say, okay, I got it. So here's how I would approach that. I would only worry about if you say it doesn't, like if it does it go higher before it goes to 25K. Again, I agree with Gil. You're not guaranteed 25K.